So I need that VPA from Momentum. I need that thing. Here it is. Okay, that's what I need. Well, let me just open this one.
All right, I'm going to start letting people in.
Just give it to everyone. We'll just give it another few minutes, waiting for everybody to log in, and then we'll start. Danny, whenever you think I'm ready.
I think it's 5 past now. Most people should have been ready.
Okay,
we'll probably
welcome.
still get a few more people, but let's start now, I think.
Yeah, let's start. Welcome, everybody. Thanks for joining us. We are very proud to have Herb Lewis with us today to discuss retirement fund tax. We did receive the notes and we've distributed them a few minutes ago. If you didn't receive them, please let us know via the chat and we'll resend them to you. But I think everybody should be receiving them now. We're going to begin in a moment. I'd just like to take a moment to introduce Herb. He's an investment advisor, but his expertise is in retirement. And I don't know if he's retired, but he's going to talk to you about retiring and talk to you about the taxes that you can expect when you're investing, what the government takes from you, and you then have to pay over. So, Herb, I don't want to spoil the party, so I'm going to hand over to you and let you go. I see there are 1 or 2 messages of people who haven't received the notes, and I will send them out in a moment. But Herb, over to you.
Thank you for having me and letting me present. I'm going to discuss the world of investment, the world of investments as the central topic and tax as the consequence of that. Am I being clearly heard? Am I coming across clearly?
Yeah.
Yeah.
Perfect, my side.
Okay, good. This question is, it's a wide topic. Where do you start and where do you end? And I've decided not to cover just the range of retirement products. I've decided to discuss the process of retirement and the products involved in that process. So we will discuss formal retirement products offered in this country and non-formal retirement funding products used for the purposes of retirement. The whole gamut of products, and the few questions that I was asked related mostly to covering the range of investment products in the industry and then the tax consequences of that. So that's the approach. It's a wider approach, but we'll cover all the material. We'll look at the process of retirement and everything involved in maximizing what we do accumulate for retirement. So I firstly have to give credit and thanks to the material that I've extracted from the various investment companies and the life assurers. And all I've done is I've repackaged that ideally in a very structured and meaningful way. And I can tell you, I learned the ropes in America, fortunately, in the investment industry. And I can say that I think that South Africa is not world standard, it's world leading in the investment industry. We really understand the range of investment products, who they're intended for, how they work, and we do an excellent job of administering them well. Really a lot to be proud about, and I hope I do credit to those in the industry that have made such a large contribution. Okay, so the process of presenting on retirement tax is a three-step process in my view. I mean, there are many ways of doing this, and my approach first is to understand the range of products in the marketplace, because if we don't know the range, we can't really discuss the tax implications of those products and what events trigger tax in the first place. So I'll be giving you what I think is a structured and meaningful overview of the range of products in the marketplace. And by the end of this presentation, you'll be very familiar with what's on offer, how it fits in. And then we'll move on to the events that trigger tax and the applicable tax as a consequence of that event. So number one, what are the products? Number two, what events trigger tax? Number three, what tax is triggered? So in the investment industry, the whole purpose of retirement funding is to accumulate as much as possible. And that's not an easy process. Ideally, money grows in real terms at a rate in excess of inflation. And it's a very important requirement on investment advisors and those in the entire retirement funding industry to make sure that happens, that money in the future is worth more than money now. And one of the largest contributors to incentivize us to do so is the tax deductibility on contributions, even if not well understood, because if one's a member of a pension or provident fund, one's membership is compulsory. One doesn't appreciate the underlying benefit of the contribution. One just knows one has to contribute. And thank goodness that we do have to contribute. You can imagine the state of one's post-retirement financial status or state if we didn't have to make those contributions throughout our working life. And in fact, in my own experience, those that have saved the most for retirement are those that have funded uninterruptedly throughout their working life, and generally those that have changed companies few times, and generally those that work for somebody that offers a pension or provident fund. Self-employed tend to sometimes slip through the net in terms of their contributions, certainly periodically. And then, of course, there's the whole emphasis on future independence. The gist of this presentation is investment performance first, before tax considerations. All else equal, we minimize tax. But the objective is maximum growth and the tax consequences of that. Okay, the slide isn't coming out very nicely. Let me check on something over here. Where's my slide? Not quite. Okay, so I'm not seeing this very well. I'm just going to jump screen slightly because I'll come back to that slide. I'm just going to do something over here that I'm not seeing the slide very well. Just give me a second. Cut off slightly over here. I'm not quite sure why. Let's have a look over here. Okay. Daniel, can you see, is your slide also cut off? Stan, It seems to have been partially.
Yeah, mine's also cut off on my side. I'm just trying to look at the notes and see if I see anything on my side. On my notes, it's also if you exit your presentation, it makes it, you can see it, but in the presentation, it cuts off.
Okay, so let's just do this for a second. And let's just get back to here. Okay, so can you see that?
Yes, that works.
All right, so let's look at that for a second. So this is a chronology of the investment industry in this country. From the time that we start working, or if we inherit monies prior to working, and we're going to look at this timeline as to what products are on offer during our lifetimes. Again, a full assortment of products to satisfy every need. And I need to classify this, to break this down, because as I said earlier, this is the essence of understanding retirement fund tax. We have to understand how products are classified and what purpose they serve. So let's look at this darker area over here. In other words, everything to the left of this vertical line. This vertical line over here is retirement. So let's call this the accumulation phase over here. So in the accumulation phase, we're either funding for the longer term, let's call that retirement, or we're funding for the shorter term. And this distinction is absolutely key because there are many qualities or attributes or characteristics of a formal retirement funding product versus a non-formal retirement funding product. So if these are retirement funding products, and I'll get onto them in a second, then a non-retirement funding product in the industry, using investment jargon, parlance, is a discretionary or a voluntary type of investment versus a retirement funding type of investment. And the objective obviously is to accumulate enough money either through a formal retirement fund or funds, we'll get onto them in a second, or with our discretionary type monies, we'll get onto them in a second. And at retirement, at this vertical line over here, we hope to have built up as big a pool as possible. And then we start to draw down on that pot of money to replace the income that we would otherwise have received via salary or earnings in our working years. So let's get back to the accumulation phase over here. And by the way, I have shaded the background in lighter and lighter colors to represent one's typical risk profile, one's exposure to equities or stocks, to volatility, if you like, or temporary fluctuations in one's investment value. Because generally, the longer the time frame until one wishes to access the money, the more one has the willingness to invest in stocks or higher growth assets. And as one approaches retirement generally, and there are many exceptions to this, one tends to be more conservative in the fear that one will not have enough time, or in fact, the mindset to endure massive fluctuation in investment value. Okay, so let's get to the accumulation phase. Two phases, as we said, retirement funding and discretionary. There are 4 retirement products in this country. So there's a pension and a provident fund, if your company provides one, and if your company does, membership is compulsory. Thank goodness for that. If you wish to self-fund, if you wish to supplement your pension or provident fund, or if your company does not provide a pension or provident fund, or if you're self-employed, then the retirement fund for you is a retirement annuity. In all 3 cases, the major incentive here is the tax deductibility on the contribution. And that's expressed in many ways. So a typical way would be if you earn 500,000 Rand and you contribute 50,000 Rand a year to an RA, you're only taxed on 500,000 Rand minus 50,000 Rand is 450,000 Rand. That's one way of expressing the appeal of the tax deductibility of the contribution. Another way that I prefer that people relate to, say, well, your contribution is 50,000 Rand, and your marginal tax rate is 40%. So the taxman will deduct or reduce your tax by your marginal tax rate of 40% times what you contribute. 40% of 50,000 Rand is a 20,000 Rand deduction. You are paying 20,000 Rand less tax than you otherwise would have. And that's a major incentive to invest in a retirement funding product. And then we have the fourth type of retirement funding product, which is a preservation fund. And as the name suggests, you are preserving your money when you leave a pension or provident fund. And if statistics are correct, we will change jobs, I don't know, 6 or 7 times in our lifetime. So we can accumulate a whole pile of preservation fund investments. And it's a necessary requirement to create a separate preservation fund for every originating pension or provident fund. And that's just to keep that link clean. So I leave Pick and Pay, the Pick and Pay pension fund, and I transfer the proceeds into a preservation fund. We'll discuss the tax implications of withdrawing money in a second, but let's go through the product range for the moment. And I then join Woolworths, and Woolworths offers a provident fund, and I contribute for a number of years, and I decide to leave Woolworths, and I then transfer the proceeds or preserve the proceeds in a second preservation fund. So by the time that I retire, I could have a whole number of different retirement funding investments. I could be in the pension or provident fund of my current employer at the time of retirement. I could have funded one or more retirement annuities, and I could have accumulated one or more preservation fund investments. And they together make up my retirement funding pot. And this is important when we get onto tax on withdrawals, because those tax on withdrawals will work with the cumulative value of all these retirement funding investments. By the way, there's no requirement to mature these products simultaneously. You could, at retirement, be forced to retire from your company. The retirement age is prescribed, but you then may continue to work. You have some discretion in that you do not have to retire or mature your other retirement funding products other than that in which you are a current member at retirement. So you could leave your retirement annuities alone, you could leave your preservation funds alone, and you would then mature your pension or provident fund of the final employer and purchase a post-retirement pension. Or if the intention was not to work, or you needed the income from the collective value of your retirement fund investments, you would encash them all. You wouldn't encash them all, you would encash actually quite a little bit. You would encash ideally only the tax-free amount, but you would transfer the proceeds net of the amount withdrawn into a post-retirement pension or annuity. So I want to get onto terminology. Many of you know the terminology, but for those that don't. So the Oxford English Dictionary definition of an annuity is an income stream. And a retirement annuity is an income stream outside of your pocket into the investment. It's a retirement funding type of investment. A post-retirement annuity that we see over here is an annuity that provides us an income from the investment. So it is an annuity, an income stream going into your pocket, whereas the retirement annuity is an income stream coming out of your pocket and funding the investment. And that's important because in the terminology, everyone gets this mixed up. Retirement annuity, pre-retirement, accumulation product, these are post-retirement. And the guaranteed annuity and the living annuity provide us with a lifelong income. They work differently. I don't have any feedback, but if there's any interest, I'm quite happy to discuss the essential differences between these two post-retirement annuities. It's not, it doesn't apply necessarily to retirement fund tax or to post-retirement income, but if anyone's interested to know the essential differences and merits, if you can just give me an indication and I'll tell you what their shortcomings and what their merits are and who they intended for. Danny, maybe you can guide me on whether it is something I should just discuss.
For now, I think let's just carry on. If anyone needs, they can always ask questions in the question and answer, and then we'll chat from there.
Okay. So in essence, both a guaranteed annuity providing you with a guarantee, a certain annuity, a certain income stream for life, or a living annuity with which you'll be familiar, where you invest your money and you draw an income within limits between 2.5% and 17.5% of the capital each year. It offers flexibility in that income. That income can be changed every year. The risk over here is that you draw too high an income, or the growth on the investment does not meet expectations. With a guaranteed annuity, the growth may be more pedestrian. Everything, by the way, with a guaranteed annuity is prescribed at the onset when you purchase this pension. Nothing can change. You cannot cancel the contract. So generally, life assurers offer these annuities. They don't take any risk with your money, generally. The money goes into a long-term government bond. Let's assume that the yield on that is somewhere between 7.5% to 8.5%. And the income that you receive for the rest of your life passes on to your is paid to you based on that kind of return. A living annuity, if invested properly, can provide you with a higher return and ideally a higher income, but that depends on investment performance. So the two risks to the living annuity are, number one, you draw too high an income, and number two, your investment advisor doesn't get you the 8 to 10% compounded growth a year. But in any case, the income drawn from a guaranteed annuity or a living annuity is subject to income tax as per the pay-as-you-earn tax table. So there's often the misconception, as you know, among your own clients, that there's some kind of alternative table or some kind of concession offered on the income you receive in your post-retirement years. And other than the slightly higher rebates, there are no benefits in terms of the income you receive. It's the same tax table from which to which your salary is applied. So let's just look at the range then of discretionary products. So the primary incentive over here is that we are incentivized by the tax deduction. Interest and capital gains are exempt within these products. We'll get onto what happens at this junction here of retirement. In a post-retirement annuity or in a living annuity, again, interest and capital gains exempt, quite useful, but you're taxed on what you draw from the product, or you draw from the income. Let's get on to our discretionary or our non-retirement funding products. Well, over here, there's no contract with the government. Here, there's a contract with the government. The government says, we'll tax incentivize you, but the intention is that you need to fund for your retirement. And at retirement, you need to purchase a pension, and you should not become dependent on the state. That's generally not just the implied contract, but the explicit contract with investors. With a discretionary investment, there is no tax incentive to invest. There's no tax deduction on the contribution. And as a consequence, there are no restrictions on withdrawal. There are restrictions on withdrawal over here. We'll get onto those in a second. There are. That's the consequence or the trade-off for the tax deductibility and the tax favorable treatment of these products. So over here, no tax advantage, so no restriction. Money in, money out. Interest is taxed generally. It's taxed at a lower rate in an endowment or a sinking fund, a life wrapper. And capital gains tax applies at a reduced rate on an endowment. We'll get onto that. But certainly, both income tax and capital gains tax applies. The benefit, though, of a discretionary funding investment like this is that you have carte blanche access or full discretion, as the investment name implies, to your own money. And that is a massive benefit, even if you sacrifice the tax advantage. So money is put in. I mean, the whole objective here would be to invest for returns in excess of money in the bank. That is your benchmark or basis of investment comparison, the basis of performance comparison, the benchmark return, if you like. And if you get it right, you can do significantly better. Of course, interest is taxable beyond your interest exemption, and gains are subject to capital gains tax. We'll discuss how you can manage that. So at retirement, one has accumulated one's formal retirement pot and one's accumulated monies of a discretionary or voluntary or non-retirement fund nature. And now we need to make the decision as to what products we're going to purchase in our post-retirement years. So with a discretionary investment, there isn't this definitive junction as there is with the retirement product, because your pension or provident fund, if you're a member of such at the time of retirement, would have a retirement date. Whereas there's no such thing with discretionary money. Those investments will continue for as long as you wish. But if you do decide to stop working, or you're compelled to stop working, and there's the need, in fact, there shouldn't just be the need, there's the tax advantage to supplement your income by drawing from, if you like, discretionary sources. So at retirement, you may have a portfolio of shares or unit trusts or money in the bank. And you then decide to start withdrawing money it is a simulated pension, if you like. They are withdrawals of capital. So analogous to going to the ATM and drawing money every month to supplement your income from your more formal sources over here. The advantage of that, of course, is that those are withdrawals of capital. They do not attract tax on income, which is a huge advantage. And we'll consider how we can exploit that, because the living annuity is subject to income tax, or the guaranteed annuity, whereas here, withdrawals are not subject to income tax. So surely there's a strategy somewhere where we can draw less from our formal retirement funding sources, less from here, and instead draw from here to supplement what we would have otherwise drawn from here, because now we're reducing the amount of taxable income. And that becomes a very effective tax strategy in doing so. There is a formal income product or voluntary income or voluntary annuity product. So while a guaranteed annuity has its source of capital, if you like, its source of funding from a formal retirement funding product, a voluntary purchase annuity has its source of money, source of capital, from voluntary sources. And I'll give an example of what these things do over here. So such an investment could be purchased anywhere typically between 5 and 20 years. You give your money to a life assurer. You've now surrendered your capital as you have with a guaranteed annuity. You have no claim to capital. Is a major shortcoming. And the life assurer will pay you an income as per the contract, a quote, and it is treated tax favorably. Only the interest earned within the investment is subject to taxation. There's no capital gains on the investment. So they are, if you like, they are withdrawals or redemptions on a monthly basis from both the interest and the original capital. And they provide two advantages: tax favorable treatment, because only the interest is taxed. I'll give an example of what a quotation on the voluntary purchase annuity looks like. And I've assumed a 20-year annuity for a 60-year-old that will take them to 80 years old as long as they live. And the other advantage of a voluntary purchased annuity, as with a guaranteed annuity, is the certainty. You are getting a certain income. It could be level, or typically it escalates at a fixed rate, and you adjust your lifestyle around your income, if possible. But there is a certainty of a income for a predefined number of years or for life. And that certainty has many benefits, like not running out of that capital prematurely that you could do within a living annuity if you draw too much or investment returns are well below expectation. So that's the voluntary purchase annuity that provides you with an income, and it is not taxed. It is not taxed as per the pay-as-you-earn tax table. So let me just show you a quote on what this looks like, because I'm a visual kind of guy. I don't understand things that I can't see. So let's just make this a little bit bigger over here. So if we have a look at this quotation over here, this is, let's have a look. Let's go to the quotation a bit higher over here. So this is a 5 million rand purchase of a voluntary purchase annuity with discretionary money. Money in the bank, unit trust, share portfolio, proceeds of the sale of the house, whatever. That 5 million rand will escalate at 5% a year to counter inflation. The initial income before tax is specified on the quotation, and the tax-free portion is indicated over here. And it clearly lays out what the tax implications are and the effective tax rate that would be well below what it would be if it was pure income, which it's not, because it's essentially a withdrawal of capital plus there's an interest component of here. But it certainly offers a lot of income certainty and very transparent in the way these things are quoted. Okay, so let me just get back to the original. Let me get back to the original slideshow. Maybe I can just. Okay. Is this screen clear to everybody, or should I just change into reading mode? Let me go back into. Okay. Is that a better image? Can you just let me know if this is a clearer image?
It still cuts out half the.
Okay, you have to get beyond that table, though. Would it get better?
After the table, it works fine.
Okay. All right. So let's just discuss what we are doing and what we're not. So this presentation does not include insurance, risk products. We're confining ourselves to investments. The taxation of risk products, of insurance products, both individual and company related, is a topic in itself. Obviously, insurance products provide for protection against large and future unexpected losses. This is well put. I extracted this from a little diagram from 91. I have extracted pieces from most of the providers, the investment providers. Investments obviously provide for a future financial need, so there's a certainty of a future value here. And the quantum, the amount of that future value, depends on how much you put in, for how long, and very importantly, what the rate of investment growth is. The moment you stop paying your contribution here, that's the end of the policy. So nicely put over here. If this is retirement, the vertical line, then life insurance protects against dying earlier than expected, and we need to invest and save and build a big enough pot to guarantee against living longer than expected. So they obviously serve very distinct and important needs. Generally, when you're younger, and there are huge repercussions in the event of your death, disability, or impairment. Over here, you may have, or should have, hopefully have accumulated investment assets. You're going to draw them down, and insurance is either less important or not important at all, because you've now saved over time and accumulated an investment pot. Okay. So we make this distinction between retirement funding products in the diagram, voluntary products, post-retirement annuities, both compulsory, the guaranteed in the living annuity, and the discretionary type, this voluntary purchase annuity. We use discretionary money to provide you with an income on a tax favorable basis. I need to make an important distinction between the product and the fund. An investment product, sometimes called a wrapper, defines the rules of withdrawal, the constraints on taking money out, and the tax treatment. Let me give an example. So a retirement annuity is a product or a wrapper. it defines the tax treatment, the tax deductibility of the contribution, the exemption of interest and capital gains, and it imposes a restriction in this case that you cannot withdraw money from a retirement annuity unless you become permanently disabled or you emigrate. You cannot withdraw pre-retirement, age 55. So that's the product. Performance is governed by the underlying unit trust fund. So often people would say, well, I've got a terrible, and often old mutual is victimized, I've got a terrible old mutual retirement annuity. So their retirement annuities are absolutely useless. And of course, that's incorrect terminology because there's nothing wrong with the product itself. Whoever advised the investor has simply not chosen the correct funds at the correct time. It's not the appropriate portfolio for the investment climate of the time. So let's take another look by way of example of product, because when we get onto tax, which we're going to do in a second, the tax treatment is essentially defined by the product. So let's look at a post-retirement living annuity investment. So what's the tax treatment? You're taxed on income drawn from your living annuity as if it was salary. By the way, and I'm getting ahead of myself over here, but the administrators and the life assurers that do offer these living annuities will apply your standard exemptions, your rebates, when they pay you. And of course, if you have in a living annuity investment, so you could have a multitude of, well, you could have several living annuity investments with more than one provider, and they'd be all offering you your standard exemptions, your rebates. And when it comes time to submit your tax return or reconcile your taxes, you may have to find that you've got to put some money in because you have been granted your rebates a multitude of times for every administrator administering a living annuity. I mean, it's not common that people have living annuities with more than one administrator, but it absolutely does happen. So again, the product or wrapper is the living annuity. The performance of the living annuity is that of the underlying portfolio. What is a portfolio? A portfolio is simply an assortment of unit trust funds that makes up that portfolio. So that's the important distinction between product and fund. Okay. So what we're going to do now, are there any questions at this stage? Daniel, can I open? Is there anything we've now gone beyond point one to some degree, and the point one is the range of investment products, the range of investment products over here. Are there any questions? Because when in part two, as we discuss the events that trigger a taxable event, one has to be familiar with a range of investment products. Any questions at this stage?
I don't see anything in the chat or questions yet.
Okay, all right, let's move on. Okay. So I put this together because we have a whole assortment of taxes, we have a whole assortment of products, and we now need to match taxes to products. So let's consider what our taxes are. We have income tax, so we've got tax on interest, we've got tax on income from our post-retirement living annuities, the guaranteed annuity and the living annuity. We have capital gains tax, we'll discuss when that applies, dividend withholding tax. So the dividend withholding tax, or the payment of the dividend, is more explicit when you hold a direct share portfolio. Those dividends are paid to you or they're reinvested. They are more implicit when you hold a unit trust portfolio, or you hold unit trusts within an endowment or within a living annuity. But when the portfolio is made up of unit trusts rather than a direct share portfolio, you're not as close to your dividends as you would otherwise be. So in the collective investment scheme world, in the unit trust world, dividends are wrapped up into something called the distribution. So unit trusts hold shares in a range of companies, and administratively it would be very burdensome burdensome if they had to continue to reinvest the dividends every time a company declared a dividend, paid a dividend. So they do so periodically. At the same time, unit trusts have some interest exposure to a greater or lesser degree. So the interest and the dividends are bundled up and are reinvested into the fund. They buy more units, if you like, or they pay to you, and that we call a distribution. And it's the distribution that triggers a potentially taxable event. The distribution made up of interest income, dividend income, property income, REIT income, and that would reflect in the distribution of the specific unit trust fund. We'll discuss when and how tax is withheld there. There are also taxes on money drawn from retirement funding products. So let's go back a second to our diagram. So here's our investment universe. Here's our timeline, a chronology of our investment lifetime. You can withdraw money from a retirement funding product pre-retirement. It's not ideal, obviously, because what's withdrawn now is not accumulated at retirement to replace your salary or income. So let's consider when you can get money out of a retirement funding product, and let's consider what the tax implications are. And the tax implications are deliberately onerous, as they should be. So you can withdraw your money from a pension or provident fund on resignation or on retrenchment, involuntary resignation, if you like. You can do so. You cannot withdraw money from a retirement annuity pre-retirement. You cannot pre-retirement unless you formally immigrate, and now there's a delay in doing that, or if you become permanently disabled. So even if you do formally immigrate and you're able to get your money out, again, because it's money taken out pre-retirement, there's a tax implication in doing so. And rightly so. The government says, we will incentivize you to fund for your retirement. We'll give you this tax contribution, the tax deduction on the contribution. We'll exempt you from interest and capital gains. But the intention is that you save for your retirement. It's we scratch your back and you scratch ours. And now you take out your money prematurely. So now if you like, the contract hasn't served its purpose. And they attempt to reverse the tax incentive they gave you because you haven't invested until the intended time frame, the intended destination point. And that's the justification behind retirement withholding tax. It's a reversal of the incentives you were initially given. Let's get to a preservation fund investment. So the origin of the money is either a prior pension fund, it would be called a preservation pension fund, or a prior provident fund, it would then be called a preservation provident fund. As you know, I'm sure you do, you are allowed one withdrawal from a preservation fund investment pre-retirement, before the money is used to purchase a post-retirement annuity. One withdrawal. It is also subject to tax, but you are allowed one withdrawal per preservation fund investment, not across all your preservation fund investments, per one. So let's consider what's going to happen over here. You leave the company, you take the money. You leave the provident fund, you take the money. What are the implications of doing so? Instead of doing ideally the best thing for you and preserving or transferring the full benefits to a preservation fund, or you emigrate and you take the proceeds of your retirement annuity. What is the applicable tax over here? So just in terms of recent legislation, so as you know, the government has delayed access to retirement annuity monies on immigration, and they've delayed access to proceeds of your preservation fund. Sort of, I need to qualify that, because the one withdrawal rule still applies. The restriction on accessing your money on immigration with a preservation fund only applies if you've already made one withdrawal. So if you've made one withdrawal, in order to access your funds to make a second withdrawal, you now have to wait 3 years. But if you haven't made one withdrawal from a preservation fund, then you can access your money. It's not an impediment in that case, but certainly it's a deterrent for those investing in a retirement annuity. Okay, so let's consider what the tax implications are of withdrawing your money pre-retirement. Remember, no restriction over here. We'll discuss what the tax implications are here, but they relate to capital gains tax, but there's no restriction on getting your money out over here. So let's jump ahead. Okay. Over here, the pre-retirement tax table applies to a pension fund, provident fund. Let me just make this a bit bigger because I'm sure I can do a better job there. So let's go to, sorry, where was I? Sorry, I can't see here. Where is my slideshow? Sure, can you help me? Sorry, I just want to go back to where I was.
Not there at the bottom.
Where is what happened to my slideshow? Sorry, I've done something here. What did I do?
You've inserted some new slides. Don't know how's it gone.
Sorry,
To the next one now.
I just want to get back to where I was. So what have we done? Just bear with me one seckie.
Can you look next to that?
Yeah.
And then up one. Into the middle one.
Sorry, just what happened here? Can we slide master file? So, what else? Sorry, I've just done something here inadvertently. Do you want to just jump in and see if you can? Okay, so let me just do something else over here, and let's just do something that's wasting your time. And let me just do this.
Now you're gonna have to close it and not save, but don't save and then open. Hopefully, yeah.
Okay.
Yeah.
Sorry about that. Okay, so let's get back to where we were, and let's view the slideshow. And let's view slideshow. Why is it not doing this? Okay, all right. So the tax tables. There are two tax tables that relate to retirement withholding tax. Daniel, is the screen large enough for you in this mode? Or should I?
It's fine for me, but otherwise press F5. I think it's the other thing to make it bigger.
Okay, so that is.
No, this is. I think because you've got two monitors, eh?
Yeah. Okay, so let's just have a look at. Let's just have a look at that. Okay, so there are two retirement fund tables, often a source of confusion. And if we have a look over here, the one tax table applies to the tax applicable pre-retirement. So you make a premature withdrawal from pension or provident fund, or retirement annuity on emigration, or you decide to exercise the one withdrawal option on a preservation fund. That is this tax table over here. And it is cumulative. So in this case, let's assume that you had a retirement fund of R1 million. Or let's make it Yeah, let's make it R1 million. So the money is withdrawn as per this tier of the table. Only 25,000 of that is tax-free. The money is put into your pocket. The general rule is that money is only subject to tax that's put into your pocket. What you transfer to a destination product is not taxed. That's the general rule. So in this case, you are putting money in your pocket and you're paying 25,000. Sorry, you're paying tax in excess of the first 25,000 withdrawn. You now make a second withdrawal from a pension or provident fund at a later stage. And of course, SARS has selective memory, and the table is cumulative. SARS will add whatever you draw subsequently to the 1 million that you've withdrawn prior, and that will subject you to an effective tax rate of 36% on the subsequent withdrawal. And that is the deterrent. The deterrent is that it is extremely tax onerous to withdraw money beyond the tax-free amount, which is negligible in this case, versus transferring the proceeds tax-free to a destination product. So instead of withdrawing the money from the pension or provident fund, it should have been preserved without any tax implication. The incentive being to accumulate money for retirement. So that then applies to these products over here. Money withdrawn pre-retirement is simply added cumulatively to that pre-retirement table. Now we reach the process of retirement. There's a separate table for retirement that also applies to involuntary retrenchment. It is less onerous. So let's consider the following scenario. So you either have or haven't made pre-retirement withdrawals during your working life, and at the end of it, you have 5 million rand in retirement funding monies. So again, we're adding the value of your final pension or provident fund to retirement annuities that you've accumulated in your lifetime, to preservation funds that you've accumulated in your lifetime. Now, you may only retire. Well, they don't insist that you stop working, but you may only effectively retire or mature these retirement funds and purchase an annuity from age 55 onwards. The objective, obviously, would be to defer that as late as possible. In fact, the Kenyan Social Security Minister several years ago said, with our longevity, we need to be retiring at 75, not 65 or 60. Obviously, the rules of the retirement fund sometimes preclude you from working longer, but the objective should be to work as long as possible if one wishes to, and if one is able to, and if one needs to financially. So we now reach retirement age of, 65 or 70. And we're going to take the collective value of all these retirement funding products, and we're going to now withdraw them. We're now going to purchase a post-retirement annuity of one of two variations, and we also wish to withdraw some of that money. Again, the general rule kicks in. Money withdrawn, put into your pocket, potentially attracts tax. Money transferred does not. So how much are we going to transfer of our cumulative retirement funding monies? Down we go. And we go to a second retirement funding table. This retirement funding table over here. You can see that it is slightly more concessionary, if you like, in terms of the taxable amount. 500,000 tax-free. And the amount that you withdraw, that you do not transfer to a post-retirement annuity, is taxed as a massive disincentive to do so. The general idea, we'll go through tax strategies at the end of the presentation once we have a knowledge of how these products work. But the general strategy would be withdraw the tax-free amount, try not spend it. There may be debts to settle and other expenditure, but what you withdraw, you're then going to transfer into a discretionary or voluntary source of money. And that's very useful in that it provides you with a source of tax-free income. So if you withdrew the first 500,000 Rand, reinvested in a unit trust portfolio, or part in a share portfolio and part more conservatively, that's an ideal source of tax-free income in your post-retirement years. This table over here, so the objective would be draw 500,000 and transfer the rest to a post-retirement annuity. So we come back to our most familiar diagram over here, a post-retirement annuity of one or other variation. The problem here is that if we have a look, let's have a look at the tax table over here. Okay. So back we come to the tax table. The problem with the tax table is that it's cumulative. So we draw the first 5 million, and we then decide to mature or retire a retirement annuity or preservation fund, and the monies are then added on. We're now applying, let's assume we withdrew another 500,000 Rand. So the second withdrawal, we apply 1,500,000 Rand to determine what the applicable tax would be. It's an additional 500,000 in subject to tax at 36%. So there's a point here of confusion. So the tax-free amounts have increased over time. So they went from, the most recent increase was the 310 to the 500,000 tax-free withdrawal amount. So somebody withdrawing 600,000 Rand when the tax-free amount was 310,000 Rand, then applies for a simulated tax directive. By the way, these are useful things, and I'm sure you're familiar with them. So instead of withdrawing monies and then finding out what the tax implication is, both pre-retirement and post-retirement, the administrators and life assurers have an arrangement with SARS whereby one can request a simulated, if you like, tax directive to tell you in advance what the withholding tax would be had you to withdraw a specified amount. And that's incredibly useful because you know the number of mistakes made when people have withdrawn monies, not appreciating that they've withdrawn prior monies already exempt of tax, subject to a tax-free withdrawal amount, and then land up paying well more in withholding tax than they ever imagined. In fact, they would not have done so had they known in advance what the tax implications would have been. So simulated tax directives are extremely useful. Okay. So the problem in withdrawing successive amounts of retirement funding monies is that it's cumulative. So the person withdrawing 600,000 Rand wants to know why any tax is applicable if they've already made a prior withdrawal. And the answer, of course, is tax is applicable because it's cumulative. You add your 600,000 Rand to any prior withdrawals and you land up with an applicable tax rate. You are granted the full concession of 500,000 Rand. You're applying the cumulative figure to the same tax table. So the fact that you do pay some tax does not mean that you're not allocated or granted the tax-free amount. But because you've withdrawn in excess of 500,000 Rand, there's going to be some withholding tax because the tax-free amount is only 500,000 Rand. Okay, so we come back to, in fact, let's go back here and consider other types of taxes. All right, then we have estate duty. We'll go through the range of products that is exempt of state duty and the range of products or product proceeds subject to estate duty and executors' fees. Systems also produce provisional tax. So for provisional taxpayers, the system allows us to generate a provisional tax certificates. Generally, they only generate the IT3A, but there are ways by which one can determine what the capital gains tax has been so far. One can extract this from the system, what it has been so far for purposes of provisional tax. Also, one knows systematically, the information is stored and available as to what income was paid. And the real problem, of course, is is the end August provisional tax figure, where we're working with estimates. In fact, not just then, I suppose, both provisional tax payments, where one has to kind of make estimates. But the information here is easily extractable from these systems. And yeah, it's commonly done for those preparing the tax affairs of investors. In terms of VAT, VAT is applicable on both. Okay, so there are 3 tiers of fees in the industry. The unit trust companies, let's work with unit trusts. We could work with other forms of investments. So fees apply irrespective of the product. Unit trust funds levy a fee. The fund managers need to get paid for their expertise and ideally to realize performance well in excess of money market returns and well in excess of their peer groups. The administrator is the institution administering the product, offering the product, offering the computer systems and the client service center, getting all the regulatory approval. They levy a fee. In fact, that fee is deducted from the investment itself. It's a very explicit transaction. They levy VAT, and the advisory fee for the advice rendered to place the investment, to liaise with the client, to understand their risk return profile, and to position them accordingly. VAT for VATable advisory firms is also levied on the advisory fee. So let's have a look at the types of taxes applicable to the specific types of product. So IT3B issued by the institutions, the administrators. IT3Bs apply only to discretionary products. Okay. So let's do this again. I just want to make this a little bit bigger because I think you need to see it slightly bigger than that. Okay, is that a bit clearer? I hope it's a bit clearer. All right. So discretionary products, non-retirement funding products. In other words, these babies over here, these babies over here, and these babies over here, non-retirement funding. These guys are subject to tax on interest. IT3B is issued. It can either be issued provisionally or it's issued following the end of the tax year. And it applies to any investment with an interest component. And unit trust funds often have an interest component. They are not pure equity funds, and even pure equity unit trust funds typically have 5 to 10% in money market to honor their own withdrawals or redemptions. So there's generally, and the IT3B here is issued across your various funds. It's issued by the administrator on a per product basis. Let's get on to endowments or life wrappers. So endowments, all right, endowments or sinking fund policies, you'd all be familiar with them. So these guys over here, endowments or sinking fund policies that fit in over here, they generally have a 5-year term. In the old days, they were sold for 10 and 20 years. They were missold for that duration. The incentive with, and there's several advantages of endowments, but let's discuss the tax advantage. So via arrangement with SARS, if an investor was happy to invest their money for a minimum period of 5 years, income tax fixed at 30% and CGT at 12%, the 40% participation rate of 30% tax. And for those paying more than 30% income tax, it's tax advantageous to invest in an endowment. So yes, you're not subject to interest at your marginal rate of tax. You're subject to a fixed rate of income tax. Of course, the product is inappropriate if you would otherwise be paying less than 30% income tax. And that's unfortunately one of the problems, that people are missold these products, long-term investments that are tax disadvantageous. But discretionary products, including life wrappers, endowments, and sinking funds, we'll get onto what a sinking fund is in a second, subject to income tax. Capital, let's get onto income tax from a living annuity. So the RP5 would be issued, IT3A, and that is income on a monthly or less frequent basis paid from a post-retirement living or guaranteed annuity. Remember, the voluntary purchased annuity is not subject to income tax. So we're talking about products over here. We're talking about products in the post-retirement space, the guaranteed or living annuity area over there. And that is subject to income tax as per the income tax table. Capital gains applies to discretionary investments, non-retirement funding investments. So you'd be issued with an IT3C, and it also applies to so-called life wrappers. Why are they called life wrappers? Because endowments and sinking fund policies are governed by the Long-Term Insurance Act. So they are called life wrappers. The more favorable 12% capital gains tax. The tax advantage here, which we'll discuss in a second, is that the tax is withheld from in the investment itself, which means it's ring-fenced or separated from the investor's own tax affairs. So what a nice form of tax splitting, where you can apportion some of the tax to the life wrapper and the rest to the individual's own, to the individual's own capacity. A very effective form of ensuring that we don't get higher and higher marginal rates of tax by doing the separation. There are other advantages to endowments. In fact, I might as well mention, we'll discuss them in a second, because I see we'll discuss them in the context of estate duty and elsewhere. Okay. Dividend withholding tax applies, except in the case of discretionary products, including endowments. So, put another way, retirement funding products, exempt of income tax, exempt of capital gains tax, exempt of dividend withholding tax. And that makes them very enticing. And of course, we haven't made mention of, or we have previously, but I haven't itemized separately here, the tax deductibility of the contribution when contributing to a retirement annuity or contributing to a pension or provident fund. Of course, you don't contribute with out-of-pocket money to a preservation fund. The source of money there would have been the originating pension or provident fund. So a preservation fund doesn't receive out-of-pocket monies. The pre-retirement and post-retirement tax tables we've discussed. So if you withdraw your money pre-retirement from a pension fund on leaving the company, on a provident fund on leaving the company, on an RA on emigrating or becoming permanently disabled, otherwise there are restrictions, you can't get your money out pre-retirement, or exercising the one withdrawal option, possibly a second withdrawal option on immigration from a preservation fund money. Here's the disincentive in the pre-retirement tax table that we had a look at a little earlier. More onerous of the two, pre-retirement. Let's get on to estate duty. So again, another benefit of a retirement funding product, pension, provident, RA, preservation fund, post-retirement, living annuity. So it doesn't apply to a post-retirement guaranteed annuity, because with a guaranteed annuity, you surrender your money to a life assurer, you've met your obligation, you've purchased the annuity, and the life assurer's obligation is to pay you for life. If you die beyond the guaranteed term is, as the name implies, it's a term during which the life assurer is guaranteed to pay either you or your beneficiary, typically your spouse or your named beneficiary. But beyond the guaranteed term, there's no obligation for the life assurer to pay. And that's because this is all done as per actuarial tables. It will continue to pay you for as long as you live, and those that live beyond their expected mortality age will continue to receive the income as per the contract, and those that die prematurely will essentially, or prior to your expected mortality age, will essentially be funding those that live beyond their mortality age. But there's no capital with a guaranteed annuity. You've surrendered it all. With a living annuity, on your death or on the death of the annuitant, the capital passes to the beneficiaries, the spouse, the children. So on the second to die spouse, let's assume that the the beneficiaries are the children. That explains the reason why younger people are owners of living annuities. They inherited them well before their own retirement. And again, they are then subject to the same rules of restriction in terms of the income withdrawn, 2.5% to 17.5%. And of course, this money over here would be taxed at their marginal rate of tax. It's taxable income like any other source. But the advantage here is that capital does pass down generationally. Just have to get right by restricting the rate of depletion of income to no more than, 5 to 6.5% of capital, and making sure that compounded growth is 8 to 10% a year. And then it's a fantastic product, a South African development, by the way, about 1992, South African product. Okay, so let's go down to where we were on estate duty. So estate duty is exempt on retirement funding products. It applies to discretionary money, unit trusts, share portfolios. It also applies to retirement annuities where you have a disallowed or unused tax deductible RA contribution. So you'd be aware of the strategy by which that has now been removed. So Mr. A has a 10 million Rand retirement annuity. Sorry, he doesn't. He has a 10 million Rand share portfolio. His estate duty exemption is 3.5 or 7 million, depending. Let's assume that it's 3.5 million. He doesn't want to be paying 20, or nor his beneficiaries want to be paying 20% estate duty in excess of his estate duty abatement. So, what was the strategy? Buy a retirement annuity. The retirement annuity, of course, wouldn't enjoy the tax deduction, or not the full tax deduction. At the moment, the tax deduction, 27.5% of one's taxable income, capped at 350,000. So now we're contributing to a retirement annuity of an amount in excess of one's deductible amount. So before this gap was actually closed or plugged, any contribution that was not allowed as a deduction was added to your tax-free amount at retirement or at death. So what did that do? In went 10 million Rand into a retirement annuity. Mr. X passes away. His tax-free withdrawal, the tax-free withdrawal amount that is applied to Mr. X, the deceased, is now 10 million plus 500,000 Rand, and his beneficiaries exercise that. They take 10,500,000 tax-free. It just seems such a simple way to circumvent estate duty. So I just want to get onto when else this tax table is applied. So we said this is a post-retirement tax, or it's a tax table that applies at retirement. It also applies at death. So let's just go back a second. So we said, boom, you have the collective value of your retirement funding products, and you retire over here. How much can you withdraw tax-free? 500,000 Rand plus any contribution to a retirement annuity that did not enjoy a tax deduction. And to avoid exploiting the estate duty applicable, as I've just mentioned in the example, what they've done, and what SARS has now done is said, fine, you can take let's use the previous example, you're at death, sorry, I needed to mention that. The tax table applicable at retirement is also applicable at death of the annuitant. So that table applicable here, same table, and that tax table applicable here. let's consider the cumulative effect of that. So down we go. So at retirement, Mr. X takes out 500,000 tax-free. He now passes away. What are the options? And he has a living annuity investment worth, I don't know, let's keep the figures simple, 1 million rand. So what would happen is, and it's not bequeathed to us, it's not bequeathed, all right, it's bequeathed to these two children. In that case, and the two children wish to withdraw the proceeds, they live overseas or they want access to the capital, they don't wish to transfer the 1 million of the deceased, 50% into their own living annuity. So we get to the general rule, money put into your pocket is potentially taxable beyond the tax-free amount. So what are the children in for over here? The children are in for 500,000 already withdrawn, 1 million rand over here that the children wish to withdraw from the living annuity. The 1 million rand is added to what was withdrawn previously, and then the tax is determined as per this tax table. So not only is this cumulative for the same person at retirement, the tax table is cumulative at death as well. And that determines the post-tax amount is then paid to the beneficiaries on the death of the annuitant over here. So difficult if I'm explaining things because I'm not getting, we're not interacting, but I hope I've explained that the tax treatment on death is the same tax table as that applied at retirement to the deceased. So depending on how much has already been withdrawn tax-free, or how much has in fact been subject to this tax table, is then added on at the time of death, and the net proceeds paid to the beneficiaries. Okay, so let's get back to what I'm trying to say. Let's get back to what I'm trying to say over here. So, getting back to this retirement annuity, I'm digressing a little bit, but let me get back on course. So, a retirement annuity contributions that were disallowed do allow you to take a larger tax-free amount. We said that Mr. X put in another 10 million rand, and that increased his tax-free amount to 500,000 rand that he would have ordinarily got. On his death, this tax table applies again. So there's 10,500,000 rand tax-free. The problem, though, that the 10 million rand that Mr. X invested in an RA was not tax deductible. He had already used up his tax deduction for the year. So how is SARS going to disincentivize people from employing this tactic? Or more importantly, how is SARS going to lay its hands on money that it otherwise believes should have fallen into the estate duty net? And the answer is here, that any RA contribution that did not enjoy a tax deduction may be allowed tax-free within the retirement funding table, but it's going to attract estate duty. And that's the disincentive for people to put large amounts in RAs to try and circumvent estate duty. Have I explained that point well as the disincentive to what was previously a too simple a strategy to avoid estate duty? If we have a look at executors' fees over here, so estate duty, not applicable, pension or provident fund. So somebody died. Here's an interesting one. So let's consider the scenario of the various retirement funding products. You're a member of a pension fund and you pass away. What happens, or a member of a provident fund, what happens to the proceeds of that money? Well, the trustees of the retirement fund ensure that the money goes to the spouse or any financial dependents in the absence of a spouse or partner. What's the applicable tax table? So those inheriting the money, now we're looking at the death of the retirement fund member. The first 500,000 Rand withdrawn tax-free, the rest subject to tax. Huge incentive for the beneficiaries of a pension or provident fund, to actually transfer the proceeds and into a living annuity of their own. So the proceeds of the pension or provident fund over here, not subject to estate duty, only potentially subject to retirement fund withholding tax as per the retirement withholding table. I hope that's explained. Again, on death, the applicable tax for a retirement funding product is the second of the tables, and it's taxed in the hands of the deceased, of the retirement fund member. The same is true with a provident fund. The same is true with a retirement annuity. These products deliberately circumvent any estate. They go from retirement fund member to beneficiary as quickly and as tax efficiently as possible, because financial dependents need their money as soon as possible. So here's another interesting one. So retirement annuity. Let's assume that a member dies when a member of a retirement annuity passes away, and the spouse is named as the beneficiary. What are the options in terms of where the money goes, and what are the tax implications of doing so? So again, 500,000 Rand, tax-free potentially. And beyond that, any amount withdrawn is subject to retirement fund tax as per the table again. With a pension fund and a retirement annuity, as you know, they withdraw only 1/3 of the proceeds. So, sorry, not at death. Let's ignore that for the moment. So the amount withdrawn, 500,000 Rand tax-free. We'll get onto the 1/3 at retirement. I should have discussed that. The beneficiary cannot, in their own right, purchase a retirement annuity, as with the pension or provident fund. The requirement is to purchase a post-retirement pension. Whatever amounts are transferred to the post-retirement pension, irrespective of the age of the beneficiary, would not attract tax. The general rule, what's not withdrawn, put into one's pocket, is not subject to tax. And the same applies to a preservation fund investment. You don't inherit a preservation fund investment in your own right as a beneficiary. What you inherit essentially is a pension in your own right, irrespective of your age. Okay, so that's an important thing. I've just been reminded what I forgot to mention. We talk about the lump sum over here. You want to build as big a pot as possible at retirement that will allow you to draw as big an income as possible in your post-retirement years to replace your pre-retirement salary or income. The law has now been aligned between a pension or provident fund. But as you know, at retirement, you could only withdraw 1/3 of the value of your pension fund, 1/3 the value of your RA, and 1/3 of the value of your preservation pension fund. In other words, a pension fund that originated from a pension fund, a preservation pension fund. The remaining 2/3 had to purchase a post-retirement annuity. So it was only the amount withdrawn that was potentially subject to tax. 500,000 employees, that second tax table I made mention of. Now the law has been aligned, and correctly so. The advantage of limiting one to only 1/3 is that 2/3 had to meet the original objective of funding for your retirement. If you could take all the money, even though there was a major disincentive in the form of onerous tax, people still took their money. And that didn't satisfy their own needs shortly thereafter, and certainly not the government's needs, where people didn't have enough money to sustain themselves in their post-retirement years. So now with a provident fund, certainly starting now, money's accumulated from now on. At the time of one's retirement, one can only withdraw 1/3 of the proceeds. Ideally, that's below the 500,000 tax-free amount. And beyond that, one must purchase a post-retirement annuity of these two variations. And that enforces a post-retirement income. So in that context, it's a very necessary and overdue law in my view. So again, estate duty not applicable on pre or post-retirement funding products. Not applicable. And of course, if estate duty is not applicable, nor is executors' fees. So let's get on to executors' fees. So into one's estate goes one's discretionary investments, share portfolios, unit trusts, money in the bank, properties, life wrappers. Now, there are two types of life wrappers. One is the endowment and one is the sinking fund. And their mechanics are different. The tax treatment is the same, 30% on interest, 12% capital gains tax. But let's talk about the sinking fund policy. On the death of the investor, the proceeds, there's provision for a named beneficiary. The proceeds are paid directly to the beneficiary of the policy. It does not trigger capital gains tax at death, whereas capital gains tax is triggered at death on these other discretionary investments. It is not triggered on death. The money passes. If you choose to continue with the sinking fund policy as the beneficiary, capital gains tax is essentially rolled over. It's only money withdrawn that will trigger capital gains tax from a sinking fund policy. But the other benefit over here is that while it is part of one's estate, it does not trigger executors' fees because the monies that either remain in the sinking fund, if the beneficiary wishes to continue with such, or even withdraws the money from the sinking fund, the monies are not administered by the executor. And there certainly is a tax saving there. So the life wrapper offers a few advantages. The traditional endowment or the more advantageous sinking fund variation. Number one, the tax favorable treatment. Number two, in terms of 30% income tax and 12% capital gains tax. Number two, this concept of splitting one's tax between life wrapper, endowment or sinking fund, and one's personal tax affairs. That's a very useful tax splitting technique. And the other is the saving, not on estate duty, but the saving on executors' fees. And of course, very importantly, the time taken within which the beneficiary receives the proceeds of the policy. The money is not tied up in the estate. That is a very key component and a primary advantage of essentially an insurance product like this, governed by the Long-Term Insurance Act. Okay, we've discussed provisional tax. We can prepare all of that, and we've discussed VAT on fees. So let's advance to the next slide. What triggers tax? So we have a range of products. So we're coming to number 3 here. We're now understanding the products in the marketplace. We're then recognizing the events that trigger a taxable event. What are those events again? Let's just summarize. So we are withdrawing money from a pension or provident fund on resignation. We are withdrawing money from a pension or provident fund. We're withdrawing money from a preservation fund pre-retirement. We are retiring. That's an event that triggers a taxable event. We are withdrawing money from my unit trust portfolio. I am getting divorced. We'll discuss that. Or I die. Those are events that trigger taxable events. So what's the applicable tax payable? So let's go to the third element of the third piece of the puzzle. So these are the taxes. What events trigger them? So if you are invested in a taxable, a non-tax exempt product, in other words, a non-retirement fund product, interest accrues monthly. In fact, depending on the fund, interest probably is only reinvested in the distribution paid quarterly, sometimes half yearly, or sometimes even yearly. And tax on interest would be then paid then. Tax on dividends would be paid then. A switch or withdrawal. So when one withdraws money from a retirement fund product, the money is subject to tax as per the tax tables, pre-retirement, post-retirement, right? Those are withdrawals from a retirement funding product. And if one withdraws money from a discretionary investment, it's subject to capital gains tax. And that presents both an advantage or a disadvantage. So I just want to come back to why I harp on, I labor the point between a retirement funding product, pre and post, and discretionary monies. The tax treatment is so different between this range here and this range here. So now we're looking in this range here. This is the accumulation phase of our lifetimes in discretionary investments, non-retirement funding. And we decide to withdraw money, or we decide to switch from one fund to another. So let's consider the two scenarios. So I decide to withdraw part of my investment or liquidate the full investment. It's a discretionary investment, or it's an endowment that has served more than 5 years. With an endowment, you do have access to your money within the first 5 years, either via withdrawal or ideally via a loan, where the money's paid to you under the agreement of a loan, which gives you the option to put the money back into the endowment. And why would you want to do that? Because once the endowment has matured after 5 years, it remains within the endowment without any restriction on withdrawal. You're now beyond the 5-year withdrawal term, but the tax treatment remains the same as it was during the first 5 years. 30% income tax, 12% capital gains tax, proceeds passed to beneficiary immediately, no executor's fees. So the real merits of an endowment are beyond the first 5 years. Or should I say the additional benefits of an endowment are beyond the first 5 years when there are no restrictions on accessing the money. Okay, so a switch or a realignment of one's share portfolio also attracts capital gains tax. So from the perspective of a financial or an investment advisor, there's a real deterrent to switching money. Because once you've made money in a specific fund, for example, let's assume we have a portfolio of unit trust funds, and there's a specific fund that has made a lot of money over time. But over time, it's either become inappropriate for the prevailing investment climate, or it's become a poor performer. The investor is putting a lot of pressure on the advisor to get out of the fund. What's the problem? The major deterrent here is the historic capital gain. So nobody wants to pay tax. So even if you persuade the investor that there will be a resultant gain over time by switching from Fund A to Fund B, the problem is that they're going to realize the capital gain when they next assessed. They need to make that payment. It's not withheld by the administrator, by the way. It's only paid on assessment, the capital gain. If you're a provisional taxpayer, even sooner, depending on the time of the year. But you need to convince the investor that as a result of the switch, let's assume that the capital gains tax will amount to 2%, of the amount switched. It means that over time, you need to realize well more than 2% to justify the switch in the first place from the new fund. Now, there's no certainty of doing so. That's the first problem. The second problem is the investor doesn't want to be paying tax. They quite enjoyed the benefit, but very hesitant to actually pay the capital gains tax, which can be a significant amount over time, and especially on large amounts of money. So a major detraction and distraction to aligning portfolios on a continual basis, whereas that deterrent does not exist with retirement funding monies. The problem with retirement funding monies in this country is the government. When you've got an uncertain political and economic climate, people are hesitant to over-allocate to retirement funding monies. They're naturally scared. So the government does a terrible job now and has previous governments have done in the past, where people are hesitant to put money in this country, uncertain of the fate of that money. It's a very, very unfortunate situation. So people rather put money into discretionary funds where they have carte blanche discretion to access that money. But the deterrent there is switches and withdrawals of money out of the investment attract capital gains tax. So I just want to re-emphasize the distinction between a switch and a withdrawal. So a withdrawal of money is an explicit encashment, if you like. You're taking money out the investment, it's going to land up into your bank account. With a switch, you're just realigning the portfolio. The money remains in the investment. So either you're switching with a share portfolio from share 1 to share 2, or in a unit trust from unit trust 1 to unit trust 2. It does not matter that you are not explicitly withdrawing from the investment. By virtue of switching out of a single fund or a single share, but maintaining your investment triggers a capital gains tax event. What's the opportunity there? So as you know, markets go up and markets go down. And the computer systems available to us allow us to measure, to quantify the capital gain or loss in advance of performing a switch or a withdrawal. So it's a very useful tool that in the past, and that we're going back several years now, you would only know the capital gains tax implication of a withdrawal or a switch after the fact. And people often would regret having done so, not knowing what the capital gains tax implication is. Now the systems allow us, under a whole range of scenarios, switch 50% of that, 25% that, all of that fund. What's the capital gains tax implication on a per fund basis? We know exactly what's going on a per fund basis. It allows us to exploit any capital losses. So where one fund has really been a poor performing fund, a really fraught fund, and we know if we did a switch at the end of February, prior to the end of the tax year, and we can deliberately trigger a capital loss, that's hugely advantageous because it could offset a capital gain somewhere else for the investor. And so every February, we try and determine for clients in discretionary investments, share portfolios, unit trusts, and the like, are there losers? Are there funds that have lost money since the time that they were invested, where we can trigger a deliberate capital loss? So consider this scenario. So we've got a pure equity fund, I don't know, the Coronation Top 20 Fund, and it's a top performer. And there's another fund that's triggered a massive loss. It's also a pure equity fund. Just by virtue of switching out of the poor performer and triggering the loss and going into a comparable fund, the portfolio is no different in terms of its risk profile. Still in a pure equity fund. We have deliberately triggered a capital loss and sometimes a significant capital loss. So this is the event that would trigger a tax event, the tax event being capital gains event or a capital loss. Okay. We've discussed resignation from a retirement fund. So if you resign pre-retirement, you're subject to the more onerous tax table. This baby over here. Okay. If you get retrenched, involuntary retrenchment. Let's assume you get retrenched without severance pay. As long as it's involuntary retrenchment, SARS allows you to apply any amount withdrawn from your retirement fund, the pension or provident fund of the company from which you've been retrenched. SARS allows you to apply the more tax favorable table, rather than, even though you pre-retirement in terms of your stage of life, SARS allows an application to this table to give you the 500,000 tax-free and the less onerous tax treatment. The problem is, though, that, and okay, let me take that further before I say what I'm going to say next. And let's also assume that you've received a severance benefit from your employer from which you've been retrenched. Both the retirement fund and the severance benefit, both are applied to the more tax favorable table, if you like, rather than the pre-retirement tax table over here. So that's great in terms of the amount that you can withdraw. If you wish to withdraw, again, ideally you shouldn't be withdrawing beyond the tax-free amount. This money here, the severance benefit, you're forced to withdraw. You can't roll it over to a destination product. But the pension or provident benefit you received at retrenchment, separate to your severance benefit, that should be rolled over or transferred to a preservation fund that would therefore not attract any tax, because it's not money put into your pocket, it's money simply transferred to a new destination product. What is the disadvantage of applying your retrenchment package or severance package, and in fact part of your retirement fund if you chose to withdraw that as well? So well and good that you offered more tax favorable treatment at the time of retrenchment, but now you come to retirement, and as you know better than I do, SARS has selective memory, and SARS is going to say, Mr. X, he wants to withdraw 500,000 Rand at retirement. SARS doesn't forget that you withdrew your severance benefit and part of your retirement fund years ago when you were retrenched. And SARS then applies applicable tax here by adding, because the tax table is cumulative, by adding what you wish to now withdraw at retirement years after being retrenched to what you had withdrawn at the time of retrenchment. So that's the treatment of retrenchment from a retirement fund. Even so, if somebody was retrenched, in my own practice, if someone's retrenched and the severance benefit is paid to them, they must, and they do, apply the applicable table. It is still advantageous to have done so. I mean, you don't have any choice in the fact. You do apply this table. Better than the alternative of being taxed at your marginal tax rate, and better than being taxed as per the pre-retirement tax table that is more onerous, as you've seen. Okay, and then retirement from a retirement fund when you're retiring at retirement. So we come back here. Daniel, is everyone still out there? I'm talking to myself.
I don't know when you want to have a break. And then there's also a question from someone. Can you see it, or do you want me to read it out for you?
I think read it out. Let me just see chat questions. I see that. I have a very old endowment. Is that the question?
Yes.
Okay. Yes. Okay. When should I answer that question?
Let
me answer it now.
Yeah.
There's no time like the present. So I'll read the question for those that are not in the chat group. I have a very old endowment policy with Old Mutual. When I terminate it, does it mean that I will not have to pay tax on the proceeds I receive? The answer is yes, because income tax and CGT have been paid by the asset manager. Well, it's not the asset manager, it's the life assurer, it's the underwriter. The asset manager would manage the underlying unit trust funds, but it's the life assurer that owns the product, if you like. Okay. The quarterly investment report indicating the value of the policy, this would then presumably be the value after the payment of the various taxes by the asset manager. Okay. So even if it wasn't, by the insurer. Okay. So that's a good question. So taxes withheld within the investment itself. The interesting thing is that they try and defer the withholding of tax in the endowment as late as possible. So the investment value on the quarterly statement may be shown, and possibly is shown in this case, pre any tax implication. In other words, any CGT had you to withdraw it, because you haven't withdrawn it. Switches would have attracted CGT at the more favorable 12% rate. Unlikely that a portfolio like this would have in any case been actively managed during its lifetime. It just doesn't look like the type. So the quarterly statement would have been before capital gains tax. had you to fully withdraw it. And that's to your advantage, because the deferral of tax allows that money that would otherwise have been withdrawn from the investment to also grow. So I hope I've answered that question. But what you receive in your pocket, once you have been paid, would be net of all taxes. CGT would have been deducted by the time it hits your bank account, and 30% tax on interest would have already been deducted. But the strategy is to, as far as is administratively and technologically possible, systematically possible, to defer the deduction of accrued taxes, if you like. I hope I've answered that one here. Okay, Danny, you tell me what you'd like to do. Would you like, tell me?
Sorry, I was muted. Should we take a 5-minute break until, or 10-minute break until 4 o'clock?
Okay.
I think that's give everyone a bit of time to stretch their legs, get something to drink. And we'll see back in 5 more minutes.
Okay, let's do that. Okay.
Just a quick word, Herb, your screen's still sharing, so just be careful if you're sharing anything confidential. Welcome back, Herbs. Just before we start again, there are two questions. I don't know if you want to check, cover those and then carry on.
Okay. Abdul, I have your question. Can the heirs of a living annuity transfer the funds in the living annuity to different living annuities in order that each heir now has their own living annuity? Absolutely, that's the intention. They cannot be combined. The grandparent has passed on bequeathing the living annuity to the grandchildren. All right, so good question. So with a living annuity, the requirement is that each beneficiary inherits their own investment. Let's assume that they decide not to exercise the withdrawal. The withdrawal in terms of the post-retirement table, the table with the first 500,000 tax-free. Let's assume that they're not going to do that. So each beneficiary inherits his or own living annuity, and each decides on their own rate of income. Some would want more, some would want less. In terms of the naming of the beneficiaries, the trustees of the specific living annuity, that'd be trustees representing the administrator, Old Mutual, Momentum, Allen Gray, whatever. They make a determination based on financial need. And that's an important one. It's not like a will where the bequests of the deceased are simply carried out by the executor, unless, of course, the will is contested and the financial dependents, like the spouse, have not been provided for. But here, the test is a very rigid and thorough one in terms of financial dependence. So they would look to spouse, they would look to children rather than to grandchildren. And only if there was a strong enough justification or the absence thereof would the money go to grandchildren. My feeling, unlikely. Yeah, unlikely. But I suppose theoretically possible. Okay, so again, and credit to the product itself. The capital passes in whatever the designated allocation is, the proportion to each of the beneficiaries. They inherit their own living annuity if they decide not to withdraw the proceeds, and they will withdraw a lifelong income. Assuming the funds last beyond their own lives, it goes down intergenerationally. I hope I've answered the question, Abdul.
And then there's another question. Can you see it as well about the capital gains tax?
CGT tax, as I recall, is an extremely small portion of fiscal revenue. I think that's okay. However, my very limited experience and research, which could be misrepresentative, indicates that CGT tax presently is borne heavily in the age groups 45 to 55 and then 70 plus. Okay, so the answer is it is a small portion of revenue. It is. And I would also imagine that it's borne by those age groups, because one has to accumulate gains. One has to realize gains in order for one to be taxed on those gains. So that's that lends itself to why this specific age group. If we look at the gap between 55 and 70, well, capital gains tax is triggered at death. There's a 300,000 Rand exemption, if you like, but beyond that, unless, of course, proceeds pass to the spouse, where that spousal exemption applies. But if the spousal exemption does not apply, death, like formal immigration, is a capital gains tax trigger event. I hope I've answered that. Is it likely to go away? No.
Okay, I think then that's all of the questions. So should we carry on with the presentation?
Yes. Okay, so what I said earlier, I'm now going to, Danny, you'll tell me if I'm sharing the screen correctly. I've done some work here to fix things up. Tell me if I'm sharing.
Yeah,
Can you
perfect
see?
now.
Okay.
Perfect.
Okay, so class, we've learnt about our products, right? We've learnt about our pre-retirement products, our retirement funding products, and our post-retirement products. And we've also learnt that it's the product that defines the tax treatment, favorable or unfavorable, and constraints on withdrawal. That's the product, right? We also agree that performance is independent of the product. So I could have a frot old mutual RA, and that's not because the RA is poor, but because the underlying funds that my underperforming financial advisor recommended has not performed well. And there's no reason to stay in bad products unless you're in guaranteed products or structured products that you can't get out of, but that's infrequent. So investments have to be actively managed, and there's no cost or tax disincentive in a retirement funding product to actively manage portfolios. In this country, there's no switch fee either in or out. There's no exit fee to switch, so there's no deterrent at all. So that we agreed that in actively managing discretionary investments, that capital gains tax could be a deterrent. You know the gain in advance. Remember, we said that systematically we can check what the capital gain would be, if any, or the capital loss, right? We can exploit that prior to making a switch. And if we do recommend a switch that triggers a capital gain, we have to be damn sure that the resultant fund, the new funding, the destination fund into which we switched, provides the investor with returns of well in excess of the capital gains tax payable on switching from the previous fund. That's a tricky one, but in some cases it's glaringly apparent. In some cases it's not so evident. Okay, so that's our product range. So let's move on to, we then also discussed over here, let's do this, okay. We then discussed what the various taxes are. You know those a lot better than I do. And we try to associate or link specific taxes to specific products, which is why a thorough knowledge of products is a prerequisite for a presentation like this. Okay. And then we went on to, well, we know the products, we know the taxes. What events trigger those taxes? Certain things have to happen for tax to be triggered. And these are them here. So let's just have a look at where we last finished off. We looked at retirement, and the taxable event is retirement from a retirement fund or funds at retirement. And again, that took us to this point here in our diagram right there. So let's go beyond that. And again, ideally, you don't want to be withdrawing in excess of the 500,000 Rand tax-free amount. Of course, if you've made private withdrawals, if you've been retrenched in the past and were paid a severance package, then of course, and not only were you paid a severance package, but you withdrew part of your pension or provident fund, then you've already taken a pick out of your post-retirement tax table. You've already utilized part or all of your tax-free amount. And because the tax table is cumulative, you're going to be paying more tax than you expected. But remember that these administrators and life assurers provide us with a facility of a simulated tax directive. We can ask SARS in advance for the tax implication of withdrawing a specified amount at retirement. At any time after retirement, we can ask them repeatedly if we wish to make successive withdrawals from retirement funds, just to make sure what the tax implication would be in doing so. Okay, so of course, the general idea would be to keep transferring money from retirement product, pension or provident, into preservation, into living annuity, from living annuity into on death to beneficiaries living annuity, beneficiary's living annuity, down another generation to that beneficiary's living annuity. And as long as you're transferring money across retirement products, no tax. So if only this was a very favorable destination for people to invest, we would all do so. Politicians are naughty. They provide us the major deterrent to doing so. People are scared. They hedge their bets. It's very, very negative for the country. But enough of that. Okay, so let's go to retirement from, receipt of income from an annuity. So if you receive a living annuity or a guaranteed annuity, income subject to tax table, pays your own tax table. The administrator will pay you your monthly or quarterly or annual, semi-annual, annual income, and they will also be nice enough to provide you with your rebates based on that income and not knowing what other income you earn. And SARS allows them to do so, even though you may have to pay up a little bit on assessment. And they will then issue you with an RP5 or an IT3A, depending, there's a subtle distinction there, at the end of every tax year, because it's income as is salary. So that would have been income from these two sources there and there. So we mentioned earlier that if you take discretionary money, these babies over here, non-retirement funding money, and you decide to purchase an income for yourself for two reasons. Number one, you want to put a constraint on yourself or a restraint on not spending your own capital too quickly. You'd rather receive a monthly income. Or, given that you want to receive a monthly income, you don't want to take any investment risk in doing so. Or, you know that there's a slight tax advantage here because withdrawals from this investment don't trigger capital gains tax. You decide to purchase a voluntary purchased annuity, it's not subject to income tax. The only tax is tax on interest. You will not be receiving an IT 3A or an RP5. It's taxed within the annuity itself. I showed you the quotation for the voluntary purchased annuity. This, by the way, this is a life insurance policy as well. So it's taxed more favorably. The interest would be taxed at 30%, given that, say, it's a life wrapper or a life policy or a life product, but not subject to income tax, not the income. Interest would be at the more favorable rate of 30%. Okay, so let's keep going. So now we come to death. So death is a trigger event, if you like. So let's just consider the implications over here. So pension or provident fund would go to the beneficiary, typically the spouse, generally a financial dependent. So this is death pre-retirement. The beneficiary does not receive a pension or provident fund. Proceeds are paid in the form of a pension post-retirement. Same with a retirement annuity. Circumvents estate duty and executor's fees. The same with a preservation fund investment. If you withdraw the money at death, then the SARS applies this tax table for the deceased, taking into account any prior withdrawals from this tax table by the deceased. And that's the tax table that applies to monies received by the beneficiaries over here. So in the previously, the tax that one withdrew from a retirement fund was a function of one's own personal tax position. So you can see clearly, I mean, I know you've all considered this many times before, but by virtue of these two tax tables, one's tax treatment is independent of one's personal tax affairs, as you can see. So one's not treated in line with one's personal tax position. What is true, so that may be deemed to be non-progressive or non-sliding or whatever, or non-cascading, whatever. What is true, though, is generally wealthier people or higher earners, not wealthier people. Higher earners would have accumulated larger amounts of money and would be subject to higher rates of tax. That's not always the case, though, because if you're a lower earner, but you've been at the company for a longer time, contributing uninterruptedly, again, you'd be subject to more onerous tax than someone earning far more, but having accumulated less. So anyway, that's the way they've decided to do things. It's not dependent on one's personal tax position. Okay, so let's get back to death. So, if in a living annuity, on the application form, you designate the beneficiaries. As I've just answered Abdul earlier, the trustees of the living annuity investment, by the way, this product, interestingly, is governed by the Long-Term Insurance Act. These products, pre-retirement, are governed by the stricter Pension Funds Act. We read all the time about Regulation 28, prudential investment guidelines, restraints on where we can invest our money. And interestingly, they apply to this stage of retirement funding, the Pension Funds Act. They don't apply here. So you can invest 100% offshore in a living annuity. I'm not telling you should, but I'm saying that the restraints of Regulation 28, restrictions on asset allocation, investment mix, do not apply for a product like this. Okay, so that's just a digression in terms of, can one get enhanced performance out of something like this than something like this? Truth be told, Regulation 28 is a positive thing. People are overly optimistic about the direction of stock markets. If you look at the historical trend, you can get, I don't know, historical trend of 9 or 9.5, sometimes 10% in a high-yielding fixed interest fund invested in government and corporate bonds and another assortment. If you're in a tax-free wrapper, like a retirement funding product, no tax. That's what I call a sleep-tight, high-performing fund. Government bond returns without any tax implication, year after year after year. You can follow the vagaries of the stock market and battle to get those kind of returns. Stock markets are volatile, extremely so. And when the alternative is a tax-free investment in high-yielding interest, I would certainly allocate part of my portfolio into that. The government prescribes that you do so. And I think that's a good thing. The government is protecting ourselves against ourselves. There are restrictions, and there's a lot of criticism on the 30% offshore allocation restriction. I'm just not convinced that it's in everybody's interest, in most people's interest, to do so. It's great when what people forget to mention is offshore has done extremely well when you start off with a base level of a very strong currency. But when your base level is 1550 or 1650, I'm not so sure how well you're going to do offshore relative to your almost certain 10% tax-free and high-yielding fixed interest. So I think it's a well-thought-out regulation. High-performing, sleep-tight. Living annuity is easy to get reckless. Okay, so I'm digressing. What happens when you die in a living annuity? So again, proceeds can be withdrawn subject to the second tax table, the 500,000 Rand withdrawal. But beyond the tax-free amount, generally, the capital is passed to the beneficiaries designated on the application form, and they would in turn purchase their own living annuity separately from one another. So let's assume that the wife is the last to die spouse. She names her 2 children, 50% beneficiaries. So by the way, the deceased wife inherited a living annuity from her late husband. That then passes to 2 children. They purchase living annuities in their own right. They can choose what income they wish to withdraw between the 2.5% to 17.5% restriction, and they can choose their own investment portfolios based on their own understanding of markets, their propensity for risk, their familiarity with the markets, their required return, etc. Those living annuities become completely separate in every way. And that could pass generationally down. So ideally with a living annuity, if done right, 8 to 10% compounded growth, 5 to 6% annual income depletion, even if paid to you monthly. You won't run out of capital in your lifetime. So you look back every year and say, wow, I drew an income and I still have more capital than I started with at the beginning of the year, because your 8 to 10% growth exceeds your 5 to 6.5% depletion. So if done properly, an excellent product if well managed. Okay. Guaranteed annuity, as I meant, in terms of what happens at death. So you have surrendered your capital when you purchase such a thing, but you have a guaranteed annuity for life. The guaranteed term is a period over which I mentioned earlier, either you, or if you die within the guaranteed period, typically 5 to 10 years, your beneficiaries will be paid for at least the 5 to 10 year guaranteed term measured from the inception of the investment. But beyond the guaranteed term, the money dies. No further payments are made at death on a guaranteed annuity. So, yeah. So just by way of example, I mean, I'm being repetitive, but let me do so. You purchase a guaranteed annuity with a 10-year guaranteed term, you're 65. You pass away at 70. The life assurer will continue to pay for another 5 years from the time of your death until you would have been 75, because that had a 10-year guaranteed term to the designated beneficiary. But beyond the 10th year of the policy, payments cease. So that takes care of, sorry, we haven't gotten to death. Okay. So death within a discretionary investment. So if money bequeathed to a spouse, the spousal exemption applies. That part not bequeathed to a spouse triggers capital gains tax, possibly and estate duty. So it goes into the estate, administered by the estate at death. Except in the case of an endowment, so or a sinking fund policy. These are life insurance products, if you like, where there's provision to name a designated beneficiary or beneficiaries. The proceeds are paid to the beneficiaries. If it's a sinking fund policy versus a traditional endowment, and the beneficiary continues with a sinking fund policy, the beneficiary simply continues with the policy. It doesn't revert back to year one because there are restrictions on making more than 2 withdrawals within the first 5 years. It doesn't refer back to year one for the beneficiaries. They just continue as if the deceased had continued. They do so. Capital gains tax is not triggered. Instead, the capital gains tax implication, the base cost, is inherited by the beneficiary or beneficiaries. And capital gains tax will only be triggered on withdrawal by the beneficiaries. That makes it extremely useful. While it is subject to estate duty, it is not administered within the estate by the executor, no executor's fees, but crucially important, the proceeds pass to the beneficiary quickly, as they do within a retirement funding investment. In fact, in the case of a living annuity, money needs to be paid to the beneficiary within a month because they have expenses to pay by the very next month. So the administrators are extremely efficient and proficient at transferring the proceeds of a living annuity to the designated beneficiary quickly. And that's, of course, the very objective of doing so, which is why these products here have to be held outside of an estate where the process of winding it up is so protracted. Okay, so that takes care of death within a discretionary product, and we created the exception of the preferential treatment of an endowment or sinking fund policy governed by the life license, the so-called life wrapper. Okay, let's go on to the next one. By the way, with a voluntary purchase annuity as well, in this case, there is no guarantee period. The policy will cease to pay after the death of the insured, of the annuitant. Okay, so let's have a look okay, let's get to the issue of divorce. So the current legislation is everything is split in the middle, depending on your marital regime. But let's assume it's with accrual or community of property. So we're making the assumption that the proceeds need to be split in half at divorce. So how's that done practically? So the process is now done in the right fashion. Pension or provident fund benefits split. So there's no, as long as the recipient, so the if you like, the non-member spouse will then purchase a preservation fund investment. There's no tax on that event, as long as the non-member spouse inheriting the preservation fund doesn't decide at a later stage to withdraw the proceeds of the preservation fund, because now the investment is in his or her hands. So if he or her then decides to withdraw, exercise the one withdrawal from the preservation fund, that's separate from the divorce agreement. So now we're making a retirement we're making a withdrawal pre-retirement. That takes us down to this first tax table. That's not related to the divorce settlement, right? The divorce settlement split the investment in half, as it does, sorry, where am I? I am over here. As it does with a retirement annuity, as it does with a preservation fund investment. The proceeds are simply split and in themselves do not trigger taxable events. And the same applies with a living annuity over here. So the legislation is meeting the practical requirement of doing so. Of course, over here, things are a little bit different, but let's take a scenario over here. So I have £1 million unit trust portfolio, and the unit trust portfolio has done extremely well. In fact, it's doubled in value over time, held in the name of the wife. And now it's time to split the proceeds at divorce. So the gain is, and if it's doubled, the gain is 500,000 Rand. So initially 500 was invested, it grew by 500, and the current value is $1 million. So the husband, the ex-husband, is now going to inherit half the proceeds. The proceeds will be split. I'm assuming that there's no other arrangement by which you keep that, you keep that, you keep that. I'm assuming that practically all investments are literally split in half. There's no kind of agreement, you keep that, I'll keep that. So at the end point, you still land up with half these, half each's respective estates. In this case, the assumption is you are administratively going to split the investment. So it wouldn't really be fair to trigger capital gains tax in the investor's name, in this case, the wife. After all, there's capital gains tax of 500,000 Rand. Why should she pay for it? Or him if the roles were reversed? So again, government being very practical, no, the R1 million is split in half, 500,000, 500,000, no capital gains tax, no transfer, no anything. The spousal exemption, in fact, applies, even though they are on very unfriendly, no longer spousal terms. And the base cost of the shares or the units or whatever the instruments that were held are simply inherited by the other spouse. So the base cost is shared by both. So should the non-member investor inherit something and at a later stage sell, capital gains tax would apply the original purchase price, the same purchase price at which the former spouse had acquired the investment. Very fair. So divorce is not a capital gains tax or a trigger event, if you like, and nor should it be, because that wouldn't be fair. Okay, so let's go down. So that's divorce across the range of products right over here. Tax tables. Okay, retrenchment we've spoken about. This was a nice little slide from 91. And what we did say, though, is that you can add your severance benefit in terms of the definition of a severance benefit. You can't lump other things onto the severance benefit and enjoy the more tax favorable treatment, which is this tax table, even though you are still in your pre-retirement stage of life. The SARS does provide a concession. I mean, what SARS is really trying to offer is they're trying to offer you a higher tax-free amount at the time of retrenchment, even though you have not yet retired. Of course, as I said earlier, it clubs you later because you've now utilized part of your tax-free amount, because any future withdrawals are cumulative. You must add on to what you've already applied to this tax table. Okay, so that's all of that. And let's go on to tax saving strategies. Okay, so let's remind ourselves of the retirement funding characteristics. So my pension, provident preservation funds, and RAs, the tax deduction on the contribution, 27.5% of taxable income with a cap of 350. What you don't use, what is not recognized as a tax deduction because you've contributed in excess of that, is carried over to successive years. And in fact, if it's carried over all the way to retirement, all the way to here, because you've never actually utilized the tax deduction on a previous year's contribution, then any unused deduction increases the tax-free withdrawal amount at retirement. So a little confusing, but let's assume that you had put in 2 million rand in a retirement annuity. No, you'd put in 2,350,000 rand in a retirement annuity years prior, or the year prior to retirement, and only the 350, let's have a look here. So you had contributed in excess of the 350,000 cap. So now you've got an unused 2 million rand RA contribution. And in subsequent years, you put in 350. So you never get to use the 2 million rand excess contribution that's never enjoyed a tax deduction. And now you retire. Other way, remember, you need to go for retirement at 75. Herb said, that's the thing to do. Can still find time for 2 rounds of golf, a few games of tennis, time for the grandchildren, and work. Okay. And periodic holidays. So over here, you unused retirement contribution of 2 million. So what SAR says is, very kindly, you can then add 2 million rand as a tax-free amount from this table, because you never were able to utilize the excess RA contribution as a tax deduction. So now your tax-free amount goes from, let's assume you used 500,000 in the past, it goes to 2,500,000 rand as a tax-free withdrawal amount. I mean, that's rather nice. They give you some opportunity to use the excess contribution that never enjoyed a tax deduction. Okay, so that's great. Remember though, SARS is careful that we don't try and exploit this fact at death by circumventing estate duty. Because remember, as I said, that 2 million rand can be withdrawn tax-free by you, that's fine. But if you die, the 2 million rand plus the 500,000 rand is applied to the tax table and the benefit enjoyed by your beneficiaries on your death. So I'm laboring the point, but I need to. This tax table applies to the retiree at retirement and for every subsequent withdrawal post-retirement, because you could have a whole lot of retirement funding products that you withdraw. And it also applies at the time of death in a cumulative fashion to the same retiree. So the tax implications are then passed on to the beneficiaries at death. So the 2 million rand would allow 2 million rand tax-free withdrawal, but the 2 million rand is subject to estate duty. If it wasn't, then you could quite simply evade or avoid or circumvent, not evade, but avoid state duty by simply contributing well in excess of the tax deductible limit to an RA. Okay. So no income tax, no tax on interest, no dividend withholding tax in all your retirement funding products. We're talking about the retirement funding products, right? Pension preservation, present RA. A living annuity will tax you on income drawn, your pension, if you like, your annuity, but it won't tax you on interest earned in the living annuity. and there's no dividend withholding tax, and there's no CGT. So no executors fees and no estate duty, we've discussed that. Okay, so no estate duty, but that excludes the non-tax deductible contribution. I've just mentioned that, okay. So what's the general rule? So the general rule is that tax applies only on withdrawing from a retirement funding investment beyond the tax-free amount. What you transfer onwards and onwards and onwards does not attract tax. We should limit our lump sum withdrawals to tax-free amounts. We should preserve our retirement fund benefits upon withdrawal, even retrenchment, if possible, because the objective is to accumulate as much money as possible at retirement. So, yeah, so I mean that's the idea here. So preserve your retirement fund benefits on leaving a company on resignation. Because what you withdraw at resignation, not only is it taxed, but it's taxed more onerously, and it's cumulative. So that's the major disincentive to withdraw monies at the time that you leave a job. Rather transfer the proceeds into a preservation fund, rather preserve, as the name indicates, rather preserve the monies on a tax-free or tax-neutral basis to a preservation fund. Of course, if you don't need the money and can survive without it, I mean, it's always not easy. Yeah, that's the general idea. Try and preserve the retirement fund benefits as you leave one pension fund after another, and retire later from RAs and preservation fund investments. Why is that advantageous? So let me show you over here. So, you have to concede this is a very useful little diagram, right? I can't hear you, but my ears are ringing. It is useful. Okay, so over here, if your pension or provident fund retirement age stipulated in the rules of the fund is 65, and unfortunately and regrettably you have to retire from that company, and you have preservation funds from prior pension or provident funds, from prior employer funds, and you have RAs you've accumulated over time, there's no need, if your income requirements can be met with your pension or provident fund, or if you intend to work, if you don't need to draw an income from these other sources, there's absolutely no reason to withdraw your collective retirement fund value. You shouldn't do so. You only need to withdraw as much as you need to. In the old days, you were forced to withdraw a retirement annuity by age 69. But as our longevity extends, you don't have to do that. In fact, you never have to do it as long as you don't need to draw an income. So what's the disadvantage of maturing, of retiring these products prematurely, too early, if you like? In that the moment you purchase a post-retirement annuity, you're forced to draw an income. And when you're forced to draw an income, SARS is going to tax you at your marginal rate of, as per the tax table, at your marginal rate of tax. So you need to defer these things. You know, and there are those that would encourage you to encash them as soon as possible and purchase a post-retirement annuity, but that's simply for their own motives of taking a fee on the process. It's sometimes extremely disadvantageous to prematurely mature these things, to purchase a pension prematurely when you don't need to. Obviously, if you do need to, then you would. But if you don't need to, prefer that process. And so retire later from RAs and preservation funds. That is under your control. The retirement date from your current pension or provident fund is not under your control. That's a good one. Drawn income from both taxable and non-taxable sources. So I did touch on it previously. So back to my favorite little diagram. There it is. So I now receive an income from a living annuity. I can choose to draw an income between 2.5% and 17.5% of the capital each year. And what I really want to do is I want to make sure that the income from here is below the threshold or is as low as possible. But it's not enough to sustain me. And fortunately, I have some discretionary money from a share portfolio, unit trust portfolio, money in the bank. So as we said earlier, I'm then going to simulate an additional, supplemental pension from these sources over here. I'm going to take money out of my unit trust portfolio to supplement the money out of here. This does not attract income tax. This does. It's a great, if you like, income splitting mechanism by drawing from both. I wouldn't draw too much from here because discretionary money has its advantages. It's accessible money and in larger amounts, as and when you want the money. Whereas once you've purchased a living annuity, you can't make ad hoc withdrawals from the living annuity. The best you can do is increase your income amount or reduce the frequency of income as of the next anniversary. But there's nothing much you can do until then. So you want a delicate balance for tax saving reasons here, but you also don't want to run this down or deplete your discretionary sources too quickly because of the other advantages of accessibility that these investments provide. So non-taxed strategies. So tax advantages of endowments, sinking funds, life wrappers, 30% income tax, 12% CGT. Okay, tax splitting. I had a previous question. What's taxed in the endowment is withheld in the endowment, and if ever you withdraw the proceeds, they will be paid to you after tax. So another favorite of financial advisors, as you know, is they say, no, these things are tax exempt. You don't pay tax in an endowment. Not at all. Buy one of these. You certainly do pay tax. It's just not in your personal capacity. You may pay a preferential rate of tax, but absolutely the deduction is coming from your own money, be it at a preferential rate. But the great thing is that the taxable income earned within the endowment is not added to your other taxable income, so it doesn't push you up the tax table, which is hugely advantageous. And of course, a non-tax benefit is that the proceeds are paid to the beneficiary immediately. And with a sinking fund, even if the beneficiary is not a spouse, it does not trigger a CGT rollover. The beneficiaries inherit the investment using the base cost of the deceased. And then, of course, you are able to avoid not estate duty, but executor's fees, because the money just passes paid by the administrator to the beneficiary or beneficiaries. And again, if they keep the money in the sinking fund, there's no CGT rollover event. Another, I'm sure you discuss this with your clients, tax splitting with a spouse. You want to be holding investments in separate names if possible, to keep your marginal rate of tax lower. It's a great tax splitting tool. And of course, donations between spouses don't attract donations tax. So that's a good one. So investments would therefore be held in the name of both spouses. Okay, and then I did mention to you, a very nice technique is to deliberately trigger capital losses via switches when you know that there's been a capital loss on a fund because of, I don't know, global financial crisis, concerns that the United States are going to increase interest rates, coronavirus. But those prevent occasions to get out of a loss-making fund and into an identical fund and trigger a capital gains loss at the same time. Hugely advantageous to do so. And the systems allow you to check over the current tax year. What are your losses? What would your gains be had you to do subsequent switches, and to measure whether the subsequent switches that would trigger capital gains would be offset by deliberate capital losses in the same tax year. Even in subsequent tax years, because those losses can be carried forward. Anything I've left out?
Not that I can see.
Yeah, so there's a question here. from Mr. Staples. Okay. What are the tax implications if a South African resident dies and bequeaths a living annuity to a non-South African tax resident beneficiary who has emigrated financially? Okay, here's a good question and common event. So let's consider what the possibilities are over here. So we need to go to the diagram. Everything's explained by the diagram. So I just want to repeat the question. What are the tax implications of a South African resident dies, parents die, children all too frequently living overseas, children or child is the beneficiary of the living annuity, non-South African tax resident. So here are the options. Let's go to the diagram. So we are, yeah, Mr. Staples, right there. So what is likely to happen is that the non-resident beneficiary child wants the money and can do so. And what's the applicable tax table? Boom. Death of the annuitant, cumulative. So the proceeds of the living annuity are added on to any prior withdrawals to determine the applicable tax payable, and that money will then be paid to the non-resident beneficiary. What's the other option? And there is one. That's the likely option. Take the pain. Remember, this tax table is the deceased tax table that takes into account all prior withdrawals made by the deceased at retirement and subsequent to retirement, if multiple withdrawals were made from multiple retirement funding products post-retirement. And in fact, it would even consider a severance package years ago in the working life of the deceased. You agree with me, because the severance package would have also been subject to this more favorable tax treatment. Staples, so let's get back to the other alternative. So it's only one way to avoid tax, and that's to transfer the product onward. The general rule, tax is potentially payable or would be payable beyond the tax-free amount if withdrawn. So the non-resident beneficiary child living overseas is unlikely to have the investment transferred into a living annuity in his or her own name. Now we have that complexity because, in fact, that it's an unlikely scenario, though, that's what would happen. But certainly there'd be taxable income in the name of the non-resident beneficiary. And that money would then be paid into a South African bank account. These living annuities are not paid into foreign bank accounts. They are not. And by arrangement with your commercial bank in South Africa, the money would then be paid to the beneficiary spouse wherever he or she lives. In this case, I think it was a son. No, in fact, it was son or daughter. Paid into blocked accounts, yeah. But that's not the likely option. The likely option is that the money would be fully withdrawn, subject to tax, as you know, the tax table. This baby over here. Any other questions?
If there are no more questions, I'd like to just take a moment to thank Herb for joining us today. And I mean, he's spoken for 3 hours almost without taking breath. You hear the passion coming through, his passion for investing for tomorrow. That's the name of his company. And Herb, we really want to thank you for your time, for your trouble, for your expertise. Danny, thanks for doing all the background work, getting all the technology going. Thank you to everybody for joining us today. I just have one comment about tax. In life, you get punished for doing wrong by a fine or whatever. And conversely, you get punished by the government for doing well. Take your taxes. So it seems to be a little bit of a, maybe they need to rethink the whole thing. But anyway, wish everybody the good afternoon. Thank you. Your certificates will be on their way once we've done all the counting. And thank you, as Jill Sturck says, thank you for a very informative webinar. And with that, good night.
Pleasure.
Yeah, there was a couple other thank yous from Ian and from Stan, but I think that's all for today.
Yeah.
I hope everyone had a good for the rest, and see you again in a month's time.
Yeah.
Or late in the
Okay.
month.
A bit later in the month, we have another seminar. Yeah.
All right. And ending this now.
In fact, on the 21st of April with Ed Selst.
Yes.
Okay.